Well, hello to all of you. It's lovely to see so many almost family faces in the audience, so I'm happy to see you. I'm delighted to have this conversation with this amazing panel on one of our favorite topics, money. I think the title for the session really gives away where we're coming at this. So little money for mining, so many opportunities. First of all, let's unpack those statements and see if they hold true. What I'm going to do is just ask each of these amazing panelists to introduce themselves and tell you very quickly how they connect to the African mining scene, and then we can ask some questions and see what you think about what we say.
I thought you were going to ask them how much money do they have for us? I mean, let's cut through all the nonsense.
No, I asked them when we prepared. Do you want to start?
Hello, David Halkyard. I'm a partner at Resource Capital Funds, where I run the credit strategy. We are a 25, 26-year-old mining and metals focused PE alternative asset manager. Got a long history of investing across Africa, across a range of different commodities. And I think we continue to see it as a an interesting jurisdiction for future investment as we go forward.
Thank you. Hello, Tetiana Dzhumurat here, Principal Banker, Natural Resources, EBRD. I'm part of the mining team. EBRD has also a long history investing in mining, over 30 years. We've invested around 70 mining projects. We are a multi-development bank, private focused, and our region is Central Asia to Central Europe, Western Balkans, North Africa, and from next year, 6 sub-Saharan African countries as well.
Hello, Christophe Roux, Société Générale. I'm in charge of the mining and industry finance sector. Mining and industry explained that we consider mining as part of our entire value chain, and we tend to be involved at every stage of this value chain. So we are very active in raising capital for mines, but we also go further downstream. Mining is absolutely strategic to the energy transition, and mining is an enormous vector of sustainable development, and in that sense, mining is completely aligned and a very important part of our strategy.
So one of us is doing some public deep breathing. I
Yeah.
don't
Is it
know
me?
who it is. Do we know at the back whose microphone's a bit... Now I've made us all uncomfortable. No breathing. Just hold your breath for the next 35 minutes, okay?
We're talking about money, we're uncomfortable. I think we should take this to Brussels and we'll have, totally triangulated. All right. The first part of it's not even a question. The first part of the statement is so little money for mining. I have to be honest, one of the starkest moments of this year for me so far is reading a diagram that was published by, I think, RBC late last year, which established that mining specialist capital has scaled back in about a decade, 11 years, by 60% in the UK, 80% in Canada. So there is literally less money out there for us than ever before. And I'd like to unpack this with the three of you from your various perspectives. And maybe I'll start with David. I mean, there is, clearly a money problem, but from what you're seeing, are there segments of the sectors that are doing better than others? What's more interesting? What's performing? What is being forgotten?
I think it really depends at what point in the life cycle of the mining life cycle you're talking about. I think there's clearly a real lack of money in the exploration, project generation, advancing projects through to kind of permitting, and I think it's a challenge to raise capital to take a project through permitting. I don't think there's any real massive limit in terms of capital for a bigger company who wants to go and acquire another one. I'm sure the banks are falling over themselves to fund, BHP taking on Anglo if there was an opportunity there, and same with other big M&A opportunities in the future. So I think it really depends where you're looking, and I think it also depends on the type of capital. I don't feel there's a huge lack of debt available to projects that are in development phase. I think there's probably, for companies, there's maybe bit more of a sticker price shock in terms of the cost of that debt because the world has changed from where it was 10 years ago. So I think the challenge as always for the industry has been on the equity side, and I think those funds that you're talking about, were equity investors principally, and they've kind of pulled back for sure. But I think if you have a decent project and you're going for construction financing, there is financing available for those projects out there. But maybe it's not quite on the terms that you imagined when you go into the meeting.
Money, but too expensive. Okay, Christophe, I want to ask you the same question. Where do you see the challenges and the opportunities?
I think David made a very important point. A mining cycle is very long. So there is clearly a lack of capital for exploration. But more generally, I think the bottleneck, if you're looking at the bottleneck for finance, it is on the equity side. There is not enough equity to finance mining study, development, construction, and operation. If you look at the debt sector, I think if you have a good project, if it is well prepared, if you are well advised, there will be many alternatives available. Also very long term, because more and more development finance institutions, export credit agencies are looking at the sector and partner with banks in order to develop projects. So debt is available, but before you reach the point where you are able to raise debt, where your project is sufficiently de-risked in order to be able to commit to repay your debt, you need a very significant investment, and that's probably where the shortfall is visible in the segment.
And are you seeing this also on critical minerals, battery minerals, the ones where the hype is concentrated, or do they miraculously escape the trend?
I think it's a very good point, because minerals include a range of products which are very different by nature. And starting with the size of this market, I think the copper market is something like $400 billion of dollar. If you're looking at lithium, if you're looking at nickels, you are 6 times smaller than that. On top of that, copper, aluminium, even iron can be relatively commoditized, standardized, and it's relatively straightforward for an investor to understand the use and where the cash flow coming from that extraction will be coming from. If you start producing lithium, then you start thinking about where this product will be refined, in which form it will be refined, will it be technical grade, will it be battery grade, will it be carbonate, will it be hydroxide, what is the price for that, and eventually the hydroxide producer will not be able to sell its production to every battery manufacturer, every CAM manufacturer. So there is, across the value chain of what I would call more industrial minerals, a level of complexity which is sometimes a challenge for many investors. For these projects, lithium or rare earths or more industrial products, there is a possibility to raise debt, there is a possibility to raise equity, but you need to have the ability to view the project beyond the next stage and to understand the entire value chain. So more integrated approach, which is what we are promoting.
So criticality does not a market make, basically. Tetiana, I'm sure you're seeing the same constraints, but what does EBRD do, and what can you do about these specific problems in terms of the equity shortage upfront at the beginning of the life cycle?
Thank you, Ludivine. And I would agree that actually, I'm going to answer the question first, but actually the fact that the materials are critical doesn't really necessarily change the investor perspective. Actually, investors are more cautious, we see, through different cycles. And yes, investor base is changing, but their investments are a bit ad hoc without a real long-term strategy. From EBRD side, we can invest in different types of products, anything from equity to straight debt. And as colleagues mentioned, we see the same challenge that the projects at the earliest stage are lacking the funding. And that's why on our side, we're scaling up financing there. This summer, we're going to start our junior mining program, which is currently discussed at our board in July, which will enable more financing into those projects where a maiden resource has been identified, to help those projects to do their pre-feasibility, feasibility studies, and get them to that bankable stage that we are all looking for. But please keep in mind, these are the projects for the future. In the short term, there is a lot of cooperation needed to develop actually the projects needed for green transition.
Maybe just to add on that, I mean, I don't think there was a lack of equity for lithium in Australia, last year. The price was high, companies could raise equity very easily, and that's kind of been the classic for mining, is the price goes up and everyone piles in, then the price drops and everyone's surprised. And I think this is, partly just investor mindset. It's always easier to raise money on the way up. I think to add to what Christophe said, though, that money wasn't showing interest in building a lithium refinery because it doesn't have the same price exposure. It has a very different risk-return profile. I think, for instance, why is there less interest in rare earths, for instance? I mean, we continually get asked about rare earths, I think because of the name when we talk to investors. One, it's a tiny market. The prices are pretty rubbish, and so the equity story isn't really there. So I think if prices are strong, you'll see equity interest. Now, is it the equity that you really want, that you can rely on long-term and so on? I don't know. But I think for critical minerals, if the drivers, if everyone's talking about, come through, then I think you will see some equity interest in some of those projects. Where they are and what they are will be the key differentiator, I think.
And I think you make a good point about the fact that we have to look at all aspects of a complex value chain. And actually, I'd like to raise this with you, Christophe. Are we seeing new pools of capital enter the market? We keep talking about OEMs suddenly showing up in mining, hype, reality, somewhere in the middle. And is it having an impact? Is it changing the paradigm on some segments?
Potentially, yes. We definitely see an integration of the value chain. We see users of minerals, such as OEM, investing upstream. We see mine investing downstream as well. They either meet halfway or they bypass each other. The thing is that the reason for that is, from the consumer point of view, there is an increasing need for traceability, to be able to explain your own clients that the products which are in your product are coming from a particular sustainable environment. And there is also the requirement post-COVID and due to geopolitical tension to secure supply. Now, the interesting aspect of that evolution, which is really, I think, a structural change which happened in the last 3-4 years, is that you have a clash of business model, of culture, which is unprecedented. On the one hand, you have the OEM, which is primarily looking after security of volume and stability of price. And then you have the mining company, which will try to optimize its mining plan with volatility of supply, and then raise capital from mining investors, which will look for volatility of price because they make money on the upside. And how these two partners, potential or already existing partner, work together is a challenge which we are committed to solve. It's very interesting. It's a new paradigm, and I think that's potentially a major change in the industry.
Okay, which kind of circles back to your point. Is anybody interested in the middle bit, the unsexy refining, but the one that makes everything?
Had a call with an OEM this morning, and they clearly are thinking about the full value chain, and they are trying to work out how do they put chips along that and stimulate the things that they want. So a value chain that is ex-China for graphite, a value chain that is ex-China for lithium, a value chain that is ex-China for everything, because they don't want to be overly dependent upon China. I think different car manufacturers are taking different views, or different approaches. I think there probably was a bit of a panic initially from some car manufacturers. I think now prices have come off. There's been a bit of maybe I can take my time, and I don't need to rush out. I think there'll probably be a bit of it'll be interesting to see how some of the things they have invested in perform and whether they do what they expect and deliver when they expect. And I think that may be again a moment where they go, well, actually, are we doing the right thing? Are we investing in the right way? And so on. And that will all take time, and we'll have to see how those projects work out. So I think they're still there. I don't think they're the easy source of money that maybe they were seen as 2 years ago. But I think they are interested. But I think Christophe's right in that the key things they were looking for is a perfect world for a car manufacturer is there's too much of everything, and therefore they don't have to worry about any of this. They don't sign long-term contracts with Rio Tinto for iron ore, as far as I'm aware. So they're pretty confident on those things. It's things where they see a squeeze, and I don't think they're there for the next 20, 30, 40 years once they've sorted their initial supply needs.
And I'd like to connect this to a lot of the policy hype. I realize these are your shareholders, so we will be sensitive, but policy shapers on both sides of the Atlantic in Asia are doing their best to push new pools of capital towards mining and minerals. What do you view as the instruments that work? What should we be avoiding? And is there a change? Is there an evolution? Is there an impact?
Well, definitely, as you say, it's good that policymakers at least started to think about this and started to bring the topic to speed. They are definitely a bit behind on funding, and everybody's poking on them about that. What about the funding? Because all this policy wouldn't work without funding. They are starting to develop products, traditionally been using guarantees to the banks, which brings down cost of capital, which is important, but there are more things to be done to overall bring those projects to be more competitive as they want, if you want the sustainable value chain in certain jurisdictions, in certain places. And I think there will be more instruments developed, including blended finance, including more grant components into certain projects. And I think they realize it, but I think it will take a bit of time to develop more.
And I'm sorry, I'm going to pick on David one more time, but I read something by one of your colleagues on the Eurostar this morning, a proposal to perhaps shift some of those guarantees or some of that public money towards guarantees on pricing, perhaps alleviating this issue of downstream sector looking for absolute stability and at the same time mining companies that do want the upside. This was an argument about the value of conditional guarantee of pricing. And I mean, are we seeing innovative proposals like that prosper? Is this, I mean, I discussed this very notion with Brussels yesterday. They were not interested. Do you see other spaces where we can push for those kinds of instruments?
And I think maybe just the first question, are policymakers doing enough? I think the answer is no. I mean, they're too slow, and by the time they've finished studying their naval, the world will have moved on. We'll have to start again. So I think, and I might say this because I run a credit strategy and therefore I want to lend money and my money's not as cheap as Christophe's money. But I think for the industry as a whole and for governments, whenever there's a need for a subsidy, right, so let's provide an ECA guarantee. Right, what you're actually doing with an ECA guarantee is you're subsidizing the banks. Right, you're not subsidizing the project. Yeah, it gets a lower cost of capital, but really the benefit goes to the bank because if the project fails, you, the government, or the government, the people of the country, basically cover the loss that the banks make. There's nothing wrong with that product. It's well standard, it's well tested and tried and all the rest. But that's not what's needed now. What we need is equity for this industry. And if you want to bring in investors from, who typically target infrastructure and so on, you need to look at different ways of attracting them. Because if you look at an infrastructure project, it kind of generates, the aim is, and maybe Thames Water would be the lie of this, but it's meant to generate a steady return. And it kind of generates a debt-like return for an equity investment. One of the problems with mining for those investors, and we've spoken to a lot of these people in terms of our fundraising efforts, is they go, there's too much volatility in your cash flows and therefore the returns, and that's true. And so I think it's true in terms of fitting it into their model. Now, I think there's always a perception and a reality of that. But I think governments would do a lot better if rather than subsidizing the banks or providing an ECA guarantee, they underwrote the commodity price. And you could have a situation where kind of if you need a rare earths project, right? I don't know what the rare earths price needs to be to make a Western project work, but you underwrite that with maybe a 5% margin. So the company can go out and raise debt. It can wash its face, but it's not going to be getting rich on it. If the rare earth price goes up, the project starts to benefit from that, and you, the government, kind of gets paid back for some of the support you've provided when the price drops below your floor. I mean, in some ways, it's commodity hedging, but in a different structure. And I think doing that, you'd then be able to bring in capital from people who worry about price volatility. Now, the trade-off is you might lose some investors who are quite happy to take the price volatility, which is the traditional miners. But I think that the established products that governments roll out all the time are solving the wrong problem, but they'll just keep on doing it, I suspect.
We're making friends everywhere today.
Yep, I'm all for that.
Sorry if I may interject. I would agree with that in principle, and I think this is the everlasting debate between CapEx and OpEx. Do you need support for the CapEx? If you've got a good project, I'm not sure it is always the case. If your project is not capable to produce at a level of OpEx which is sufficient to cover your costs and repay your cost of capital, there is a fundamental issue. The only thing is I would not discard the support you get from ECAs or from multilateral agencies for investing in mining, because especially if you're talking about Africa, beyond price, there is limited capital available to take long-term credit risk in certain countries. And the ability of a bank to lend more than 10 years ahead for a project in Central Africa is, without an export credit agency, without a DFI, I would not think it's feasible. So you need a bit of both. But I agree, as far as the price is concerned, that's certainly not where support for the CapEx is needed.
Yeah.
I thought Christophe was going to agree that his capital is more expensive than his. I thought that was where you were starting the agreement. I'm just stirring for a disagreement here, Christophe.
So I see we only have 8 minutes, and I want to talk about the opportunity side. And then if anybody wants to talk taxonomies, see me after the break. Yeah, so many opportunities. My question is, there's always opportunities. What we need to establish now is, what do they need to look like? What kind of hurdle do they need to meet in order to attract your attention? And I'd like to start with you, Tetiana, because EBRD is moving into sub-Saharan Africa. First of all, welcome. Second, please bring your money, lots of it. How is that shaping some of your approach? Are you adapting or differentiating some of your approaches, depending on your geographies? Where is your mind at?
Yeah, so as EBRD, we're accustomed to work in emerging markets, so we do have experience in working in various jurisdictions under various conditions, so this is the experience we will bring with us also to Africa. But another important point is, wherever we work, we establish local presence. We would have our local offices to understand actually the local content, to understand what are the investments needs and what are the policy dialogue needs, because being an MDB, we are not only active on the investment side, but also on the policy dialogue side, fostering the business environment, basically to bring further investments, and apart from our investments, actually private capital investments of both gentlemen here, to come into those countries with more force than before. So first things first for us would be to establish that local presence, understand the background, and then bring what we do best, bring the capital and bring the policy dialogue to those countries.
Okay, so let's map the countries. I want to go back to you, David. I mean, what do these opportunities look for you? What do you require? And are there really that many opportunities?
Yeah, I don't think there are, actually. Sorry to disagree with the title, but I think there's a lot of projects that get presented to us. We see hundreds of projects every year across our different strategies. A lot of them are things that we saw 2 or 3 years ago that someone's gone, oh, the price has gone up, here you go. And it hasn't got any better in that time frame. So, let's assume that project is fine. To underwrite that from an investment, be that credit or equity, you need to really take a view on a different price outlook. And I think everyone's probably broadly agreed that commodity prices will be higher in the future than they have been in the past. But it's still difficult to underwrite a investment where, for it to work, the price has to be substantially more than it is today. So I think that's always a challenge. And that goes for projects in Africa, it goes for projects in North America, in Australia. It doesn't really matter. But I think there's just generally, big new next generation of projects are lower grade, higher cost, etc. So to get the returns, you need to have a higher price. And I think there's been a number of investment groups talking about the incentive price for copper, and maybe it needs to be $12,000 a ton, which for some of the OEMs, on the other hand, they may be going, well, that seems a little bit too high. So it's kind of catch-22 there. But I think you do need to take a view on longer-term price assumptions to underwrite some of these next generation of projects.
Yeah. And I mean, we said higher costs, lower grades, complex political conditions sometimes. how does this play out in the era of no cheap money, where, selection, prioritization, how are you evolving your views on the projects you support?
I think it never changed. We're looking at projects which are competitive, projects which are in the better half of the cost curve than the others. The cost curves will shift. The price outlook of commodities fluctuate and will change. What matters for us is to stick to the project which are producing at better cost than the others. We can always debate about what is our price deck for copper, for aluminium, for iron. I think the price deck is not our view on the market. If I knew what the market for copper would be tomorrow, I would probably have retired a long time ago. What matters for us is to make sure that if the price is not as expected, if the price crashes, the company has sufficient liquidity to wait for the cycle to rebound. And this is how we look at, but eventually the company which is capable to withhold the price cycle and to rebound when the price is low is the most competitive one, and that's what we've always been following.
And I'm going to overlap a little bit with Peter's previous conversation. Geopolitical tension, the criticality narrative, the emergence or re-emergence of new or old forms of resource nationalism. We're dealing with political risk as before, and sometimes with new layers. How do you factor that into your analysis? As before.
Yeah, I think it's as before, to be honest. I mean, political risk, in a country, I think a company, you look at a company, it has to strike a fair deal with its host country. I think the issues in the past have increasingly come from a company going in and saying, oh yeah, I don't need to pay any taxes for the next 10 years. Well, is that really a fair outcome for the host nations? I don't think that's changed. I think we are seeing more engagement around from government-related entities from a funding perspective. Can they partner on this project or that project and so on, which is positive, I guess, though each of those comes with its own strings. So, for instance, if you take North American money, I think it'd be difficult for you to sell the asset to a Chinese company. And then you've got a fiduciary duty to maximize your returns to your investors in a fund. So, how do you justify to a pension fund that I only took the 2.5 times return because it was an American company buying it rather than a Chinese company, and I could have made 3 times return. So I think some of those are things that will just kind of work through over time. We haven't seen kind of, if you like, big power play, China versus America on the ground in our investments as of yet. Maybe it will happen in the future. I hope not. But I don't think I think it's just really much the same as we've always done, to be honest.
And are you seeing regions or destinations emerging on the back of this ex-China value chain requirement, the new requests for, country of origin?
I think, for instance, the Middle East is well placed to be that kind of processing hub for, it has cheap energy, has a lot of chemical engineering skills. So a lot of those plants are really chemical plants, not mineral processing plants. So I think they are well placed. They have their own sources of money, their own objectives and so on, which we heard about a little bit earlier. So, but otherwise, I think on the whole, Western governments are looking to support projects that make sense kind of globally. I don't think there's obviously some places it's a definite no, but I don't think it's too limited at the moment.
Okay. I just want to say we have been extremely disciplined on time.
I know.
Gold star.
The audience, not so much. They've sent hundreds of questions, so we are going to run out of time, but not due to your time management. So I'm going to put the questions to you guys as they've arrived on my WhatsApp. Are you finding that ESG considerations are holding back or slowing down mining investments?
I think in terms of coming through in permitting, yes. I mean, I think that's one of the reasons permitting globally has extended. It's just reflecting increased ESG requirements, more community engagement and so on, so yes.
Any other views?
Well, I think actually it's not so much from requirements, but so much from lack of capacity on those local ministries, local permitting agencies to actually process that amount of data, that type of quality data that is coming up, because we see now much more better ESG standards of the companies that they present thousands of pages of research that have been done, but then those local permitting agencies just not equipped to understand those, just not equipped to interpret them, and then to sell it to the wider community. Say, okay, we understood it, this is right, this is in line with international standards, and this is why we're permitting it. So we see a lot of, actually the issue with the skills on the side of people actually dealing with this type of permitting and reviewing this type of ESG information.
I think probably, let me just add to that. I think permitting delays have got worse in the Western world. It's probably easier to get a permit in a lot of Africa than it is in Canada at the moment, and probably more certainty on when you'll get it. I mean, it's fine if you know when you put the papers in, it will come in 18 months. The problem is when you put the papers in and then 18 months, it's like, oh, it could be tomorrow, it could be next year, it could be whenever. You can't invest on that basis. So I'd actually say Africa's done pretty well on that side.
And I just want to give the audience some sense, because I obviously know what's coming in the program. As we get to the mining companies, the CEOs, and the ICMM, we speak about ESG a lot. So, here we talk about the suppliers of money. I think the people running the companies are extremely aware and sensitive to the trend of ESG is important. There's a comment from Lemo. The gap between mining and critical minerals production is mainly chemical industries. You're in the middle, so it's chemical industries. Is there an interest to fund this complex sector? I think we've heard enough to hear that the typical equity investor who buys a mining company is not particularly buying the mining company to get to the chemical plant. And yet, I hear many junior mining companies talking as if they're going to also build the plants and become beneficiaries. Does that sit comfortable with you, or is this a mining company stepping outside its lane? And perhaps I can start with you, Christophe.
I mean, if you're looking at certain mineral, unavoidably, you need to have a solution for the processing, the transformation, and eventually the end use of the product you're mining. And what we see very often is mining companies which are highly qualified to develop a mine, which lacks the expertise, experience of the partner to do a processing and chemical processing transformation. That is where we spend most of our time, actually, is building partnership, is working with joint venture. But it is unavoidable for a company in certain minerals not to find a partner which will allow investor to be comfortable that the products they're mining eventually will find a use and generate cash.
And of course, this plays out geopolitically. I can come to you and say, I've got the mine, and China is my partner. And you may say, no, I don't like China that much. You need to have a Western or a more acceptable partner. What would be your choice? A project that takes care of it by just shipping it to China, or a junior miner that goes all the way into this chemical step?
I think it's a stepping stone process. I mean, realistically, a junior miner, graphite's the classic one. It's like, I'm going to build this mine, I'm going to build this highly complicated plant that has to produce a spec that is so on the ball, otherwise, if it's not, it's just waste. And it's like, well, it's not really realistic. But if the mine itself is economic, and actually a lot of graphite mines is a challenge, I think, the mine without the processing, and it can ship to China in the medium term, get the mine up and running, you can actually then have a company that has a balance sheet, has cash flow, and then can actually support the R&D and everything that needs to go to doing the phase 2. I think that's the pragmatic approach. And I don't think there's massive issues with that, unless you had, a governmental investor in our funds who said it cannot go, period, to China, which we don't, and we haven't heard that at all, I think. So I think you have to be a bit pragmatic about this, and I think that's a win for the globe as a whole, and Europe and North America, if that ultimate supply comes back into those economies.
And I think we need to be pragmatic and realistic about that. There is a very big difference between different segments of the industry. In certain industries are dominated by Chinese technology and dominated by know-how, which have invested years and years in developing this competency. And we know by experience that the ramp-up of industrial plant can take several years before it delivers the output and the qualities which is expected. So having the possibility to be able to sell your product into China while you're building and learning how to process your product in Europe is something which is absolutely realistic.
Thank you. I'm going to go to a next question. The first time I read it didn't make sense, but perhaps I was just not reading it well. So let me try again. Securing an offtake for opaque markets projects is a challenge. That's what we're discussing, graphite, etc. And yet it's key to unlock capital. How could government support encourage Western OEMs to take risk? Yes. So the Americans must get Ford to take risk on the graphite project. Or, I'm not sure, I'm paraphrasing. But is there a space? Is there a lever to be pulled? Is this a space government should be more involved?
I think it's where they probably could provide more support. Yes, I mean, I think if you look at graphite, Tesla signed an offtake contract with, I think it's Syrah for their plant in the States, and that plant was, a greenfield plant and had to ramp up and do whatever it's going to do. I don't know how it's doing. So I think there is a willingness from OEMs to partner with companies to be the offtaker and so on. It's clearly not easy, and I think it's a bit chicken and egg. I think one of the things you don't fully appreciate in a lot of these backed or critical minerals is the qualification processes to get your product into the ultimate battery are really long, and they often cannot be shortcut. So you have to run your battery, for 10,000 full charges and discharges and so on. That just takes a certain amount of time. And so the challenge from an equity market is a company kind of comes along and says, yeah, we've got this project, it's great, we're going to go and get an offtake contract. And they may have been speaking with somebody for some time, and then it just seems to, what's happening, and then everyone loses interest, and that's the pressure. So I think governments could provide some support there. Maybe that's, rather than on an individual basis, like the EU would be, pan-European, supporting that kind of technological process and underwriting that from an equity or, from a financing perspective. So yes, I think that's where they could add some value.
So, Tetiana, I think this question sounds like it's going to land on your lap. And Ludivine, you're so welcome to participate in answering questions. I mean, you are here as a subject matter expert amongst other things.
Can I then perhaps just jump on the last one?
Yes.
My concern with this approach is that we've got EU policy shapers running around the world, mapping projects. The US kind of does the same with the MSP, though, of course, with no transparency, because, why would you? And as much as I see the value of policy shapers trying to get into those nooks and crannies of the value chain, we all do this for a job, and I'm very concerned to see how much energy they put into mapping projects when I think we need something a little bit more systemic. So either backing organizations or multilaterals who could actually help to underwrite this specific, issue or moment, or delegating some assets to specialist funds, yes. But we don't need the EU Commission to, actually go look for projects, look for offtake, and try and broker things. That's not their job. They disagree violently with what I just said.
I am putting a question from Stacy. The AFDB, African Development Bank, and AFC have recently announced increases in climate funds. To what are the financiers on stage looking at climate-targeted financing? Climate-targeted financing, is that the future of our industry? I nominated you because you've been very quiet, so sorry about that. I'll find an easier question later.
Thank you. Well, yes, so all the development institutions and many banks are moving into what's climate finance. We all have green targets, and in this space, there is, this mining for climate action. So if you're looking into critical raw materials, which are important for green transition, it is considered basically climate-related finance. What is more important in the industry itself, there are a lot of ways to further decarbonize the industry itself to make it basically climate neutral and then climate nature positive as well. So there are a number of things happening in the space, and they will continue to happen with help of the capital, of course.
Yeah, maybe just add to that. I don't know, I haven't seen those announcements and whether that includes mining. There's clearly lots of money out there that's targeting green tech, climate tech, etc. Speaking with a lot of those investors, surprisingly how high number of them just go, oh, I didn't realize it had that in it. There's still a disconnect between end product and where stuff comes from. So whether that money actually can flow down to mining, I'm sure some of it will do, but I don't think it's the future per se.
And maybe this is where the taxonomies come in, because the taxonomies are a categorization.
You were going to bring in this taxonomy
Yeah,
thing,
I
but you
know,
promised us over there afterwards.
No, but it is of value because it's a categorization of specific activities and investments as sustainable or towards certain sustainability goals. The UK is working on a taxonomy, Australia, the EU, it's been stalled for 18 months. But those are powerful political messages to actually bridge that knowledge gap, to say in public, without these materials, we don't achieve renewables deployment and transition goals.
I'm going to put this question to you, Christophe, because you will hear the question. Listening to David, this is why the question is coming to you. It sounds like critical minerals is not a new opportunity, rather a new tag to the old minerals and commodities. So how new is this supposed critical mineral space?
I think what is new is, first of all, the projection of volume demand. For certain minerals, the energy transition creates more demand, and the supply has not been equipped to deliver that. The other thing is it's becoming critical because after the COVID, and as I mentioned earlier, due to certain geopolitical tension, countries and companies alike start becoming wary about their ability to supply the raw material they need. And they decide that one mineral suddenly becomes critical, and if they don't have that mineral, they won't be able to service a client, or an industry or a whole economy could collapse because of the absence of certain mineral. So that has changed. Now, rare earth, lithium, cobalt, this is not new. This is, and if you ask me, the most critical mineral today is copper.
I mean, I think maybe just to add to that, sorry to...
No, David, no defensiveness.
But, I mean, is it new? It's just a bit of a branding. I mean, the industry sees it as an opportunity to raise its profile and attract capital. I mean, we owned in prior funds the Mountain Pass rare earth mine, which is now MP Materials. So that's kind of 2 generations done. We used to own the Greenbushes lithium mine, which is probably the #1 lithium mine in the world. So those were done probably 10 plus years ago, those transactions. And that's when no one was talking about energy transition or critical minerals. I think, as Christophe said, governments have realized. I mean, I think Western governments totally went to sleep maybe after the end of the Cold War and just like, yeah, it's fine to have everything manufactured somewhere else. And now they're kind of waking up after 20 years at sleep at the wheel and going, oh, actually, we do need some of this stuff for our economy. Maybe we should try and invest in it. But, I mean, that's taking them a long time to actually get money behind what they're saying.
Just to add to that, it's a great branding, as was said by colleagues, but we shouldn't also forget that certain materials can be more important going forward, and we shouldn't be only focusing for the sake of the industry itself. These are the only materials that should be now developed, because the industry as a whole needs a lot of capital, and the industry is the one which brings knowledge, skills, and everything together. So let's not just forget about other minerals in this race of critical raw materials.
I must tell you, as a panel, you've been part of history. I've never run over time, and between me and the timer, we've added 5 minutes to this session, which I didn't have. So I thank you for being part of history. To the audience, especially the online audience, I am mortally embarrassed. It will never happen again. I don't know how it happened. And I had more questions, but Ludivine, as always, thank you very much for a very, very entertaining conversation. Panel,
Amazing
thank you very
panel.
much. Thank you.